Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, I want to touch on Goldman Sachs saying that the S&P 500 is going to grow roughly 3% over the next 10 years. Okay, so basically they're seeing returns 3% over the next 10 years. In this video, I'm basically going to summarize their base case fairly. A lot of these people, they take stuff out of context. And I'm going to highlight key parts of that report with you. And I'm also going to show you some other instances of their previous similar predictions, such as this one. So just in a nutshell, just so you guys understand what's going on, their base case is that the S&P 500 is going to rise 8 to 9% over the next year to 6,300. The U.S. economy is going to grow, inflation is going to come down, the Fed is going to cut rates, earnings are going to grow 11% in 2025 and 7% in 2026, and they say that these are the building blocks to the next 12 months, a return of 9%, okay? The following 9 years, to be clear, is that they have a probable total return that an investor should anticipate in the range of negative 1% to 7%. Okay, let me repeat that. Negative 1 to 7, the midpoint being around 3%. Okay, that's the whole 3% headline that you've probably been seeing over the past few weeks. So what are the driving forces behind this thought process? Let's dive into the highlights of their report right now. Okay, so this is their 37-page report. I'm not going to go through every single part of this report, but we are going to go through a chunk of it. I've already gone through this thing twice, and the yellow highlights are my highlights, just so you know what I want to focus on. So basically, it's important to actually read these bullet points because this is what the report is in a nutshell. So they anticipate the S&P 500 delivering an annualized nominal total return of 3% during the next 10 years and roughly 1% on a real basis. So annualized nominal returns between negative 1% and 7% represents a range of likely outcomes. Okay, so during the past decade, the S&P 500 actually posted a 13% annualized total return. They model prospective long-term equity returns as a function of 5 variables. So pay attention, guys. Number 1 is starting absolute valuation. This is like a pillar within or a theme within the whole report. Stock market concentration, which I think they are correct on. I mean, not I think, I know they are. Number 3 is economic contraction frequency. This is just a guesstimate on their part. You'll see that later. Number 4 is corporate profitability. And number 5 are interest rates. So their forecast would be 4 percentage points greater than their baseline if they exclude a variable for market concentration that currently ranks near the highest level in 100 years. Okay, the 7% return would rank in the 22nd historical percentile. So basically, they're just saying, hey, the market's really concentrated right now. We're taking that into consideration. That's how we're coming up with these numbers, okay? Trust me, I read this thing 2-3 times already. The intuition for why concentration matters for long-term returns relates to growth in addition to valuation. Our historical analyses show that it's extremely difficult for any firm to maintain high levels of sales growth and profit margins over sustained periods of time. So basically what they're saying, which I'll show you later in the report, is, hey, IBM may be killing it in the 70s, but not so much in 2024, that kind of a thing. So we'll get to that later. We expect the return structure of the stock market will broaden in the future. Today's extremely high market concentration suggests that the S&P 500 equal weight benchmark, that's the SPW, is likely to outperform the cap-weighted aggregate index, SPX, by 2 to 8%, okay, 200 to 800 basis points. So this is huge. So as you all know, if you're invested in something like a cap-weighted index, like a VTI or a SPY or a VOO, for example, like a S&P 500 fund, you have the Magnificent Seven upholding a ton of that because it's cap-weighted, right? NVIDIA, Google, Meta, for example. What they're saying is that a cap equal-weighted ETF, there's a bunch out there. I can talk about it later in the video. But it's basically not placing cap weights as a priority. It's basically, hey, these are the 500 companies. Everyone gets an equal slice in this ETF. The last 2 bullet points, our forecast suggests equities will face stiff competition from other assets during the next decade. The S&P 500 has roughly a 72% probability of trailing bonds, okay, so 7 out of 10 chance of them trailing bonds, and a 33% likelihood of lagging inflation through 2034, so 1/3 probability. So basically, The whole point we invest, you guys, is to maintain and increase our purchasing power over time. That's why we invest in stocks, right? Or real estate or whatever you invest in. If I'm not even outpacing inflation, what's the point, right? So this is pretty interesting, a pretty bold statement. And then finally, our S&P 500 baseline 10-year return forecast is lower than the estimates of other market participants. So buy and sell side projections of the long-term return of U.S. stocks averages 6%, ranging from 4 to 7. You'll see later in this report that they are definitely the most, I don't want to say bearish or bleak, but they're definitely on the left side of the scale. So if I continue further, again, this is not me just reading this report. I highlighted this stuff. I went through this thing 2-3 times already. They're basically saying that this report explores and forecasts the prospective S&P 500 return during the next decade, 2024 to 2034. A differentiating feature of our forecast model is the inclusion of a variable for market concentration. I mentioned this earlier. They think that the market is extremely concentrated, a metric that is currently close to the highest level in 100 years. Our model forecasts that the S&P 500 will generate a 3% annualized nominal total return through 2034. Okay, so let's take a look at this. So let's zoom in just a little bit so you guys can see this. So this chart is telling you the S&P 500 annualized trailing 10-year returns modeled versus realized. And you can see it's been relatively close, but there's been huge deviations. So look at like the dot-com bubble, for example, right before it. Realized was actually way higher, about 5 percentage points higher than modeled. And then the rest has been relatively close, okay? So you can see that their baseline is 3%. 2 standard deviations down is 1% or negative 1%, excuse me. And then 2 standard deviations up is about 7%. Okay. So again, that negative 1 to 7% range. So let's continue. So the S&P 500 index during the past decade has posted an annualized total return of 13%. Okay. That's really good. So the annualized return translates into a 233% total return. Dividends made up 54% of this, or a quarter of that return. And then 178% of that was price gain. And then the rest was basically increased earnings, okay? So the reason I bring that up is because the 13% annualized stock market return during the past 10 years exceeded the long-term average of 11%. However, the distribution of 10-year returns since 1930 has not been symmetrically distributed. This is important, and this is why I'm highlighting this. You can see that they're predicting 3%, average is 11, past decade has been 13, and then you have some huge gain years or rolling 10 years over here since 1930. So we modeled 10-year forward annualized total returns for the S&P 500 on a monthly basis using 5 variables. This is important because this makes up the whole report essentially. So from a valuation standpoint, they take the S&P 500 cyclically adjusted PE multiple. Okay, so that's what CAPE stands for, cyclically adjusted price to earnings multiple. Okay, economic fundamentals, economic contraction frequency. You'll see here that they do how many quarters you are in a recession or GDP contraction. You'll see later in these charts. Interest rates, they use the 10-year U.S. Treasury yield. Market concentration, they take a ratio of the market cap of the largest cap stock. In this case, at the time of this recording, I believe that was NVIDIA. If it wasn't NVIDIA, then second place is Apple, versus the 75th percentile stock. Okay, so it's basically taking the top dog versus the 75th percentile stock. Okay, and they come out with that ratio. And then finally, the last 12 months, LTM S&P 500 return on equity, that's ROE. If you don't know what ROE is, check out my Stock Market for Beginners videos. So we model forward equity using the value of these metrics. I'm going to just basically tell you the definitions of what they're using. So cyclically adjusted PE, the S&P 500 price divided by average 10-year trailing earnings at the start of the return period. Market concentration, what we just talked about, the market cap of the biggest dog divided by the 75th percentile stock. Recession frequency, nominal 10-year U.S. Treasury at the start of the return period, then the S&P 500 return on equity. Okay, that's basically what we just talked about. And then you can see how they weight it. I'm not going to go into that here for the sake of this video. So valuation, through the lens of their model, the most important variable for their forecast is starting valuation. Okay, so that means, hey, in 2024, our stocks, highly valued, undervalued, overvalued. That's what they're going off of. So they're going off that cyclically adjusted price to earnings ratio. Some people may argue that PE ratios aren't relevant, okay? They're not relevant since like the mid-late 90s. That's why no one really takes the intelligent investor book seriously anymore, because we have companies with hundreds of, PE, 150x, 200x, right? It could be some high-flying tech company where PE just doesn't even matter. They throw it out the window. But I think just to kind of imply where we're at, you'll see later in this report, I think it's an okay metric, even though I do agree that the intelligent investor hasn't been relevant in 20 years, right? I read it in college and I was like, okay, great, but doesn't really apply now. So in theory, a high starting price, all else being equal, implies a lower forward return, okay? So they're basically saying buy high, sell high kind of a thing, or buy high, sell slightly lower, or buy high and be flat for 10 years. So the CAPE ratio currently equals 38x, okay, ranking at the 97th percentile since 1930, okay? It just basically saying it's really, really high right now. Market concentration, in addition to the current levels of profitability and interest rates, this is the 10-year treasury, we believe forward expected returns should also take into account the starting level of market concentration. The metric is particularly important today because the U.S. equity market currently near its highest level of concentration in 100 years. So when equity market concentration is high, performance of the aggregate index is strongly dictated by the prospects of a few stocks. Index performance in a high concentration environment will reflect a less diversified set of risks and will likely have greater realized volatility compared with returns. Okay, so what they're saying is, hey, super concentrated, more susceptible to volatility. Valuation should reflect a discount for higher volatility and less diversification during periods of extreme market concentration. They're basically saying, hey, this is very concentrated. Are you even taking this into account? So the current extremely high level of market concentration is one of the main drags on our return forecast. If our model were to exclude this variable, our baseline return forecast would be roughly 4 percentage points higher, 7% rather than 3%, and the range would be 3 to 11% rather than -1 to 7%. So this is where I kind of give Goldman Sachs a break. Yes, they're evil corporation. Yes, they're betting against their own shareholders. Yeah, I get all that stuff, all right? I'm 36. I lived through all that. My point is that they're taking into account how concentrated the market is right now. Otherwise, they would be at a more normal forecast, 3 to 11%, right, or a more common forecast. So let's take a look at this chart. So this is the annualized S&P 500 total return with and without market concentration variables. Baseline forecast, including the concentration, this is where they're at, -1, 3, and 7. That's what we talked about. This has been the actual case since 1930, 2, 7, and 22. Now, if you exclude that concentration variable, you'd be at 3, 7, 11, which we just talked about, 3 to 11. And then if you look at the percentile since 1930, excluding that concentration, you're at anywhere from 7 to 50% if you go 2 standard deviations higher, okay? So market concentration has recently surged to a multi-decade high, okay? These episodes include 1932, 1939, 1964, 73, 2000, 2009, 2020, right? Those all sound like recession years, right? So if we take a look at Exhibit 7, the 10 largest stocks in the S&P 500 account for more than a third of total market cap. Market cap of the 10 largest S&P 500 companies as a share of the total index. We are almost at all-time highs. I mean, we basically are, right? 36%. Again, this is market cap of the 10 largest S&P 500 companies as a share of the total index. If you look at it, it's all these big tech companies. We all know who they are, okay? So moving forward, because I don't want to take too much time on there. So although elevated market concentration is not a sign of near-term downside risk, high concentration is associated with lower returns over longer horizons. A highly concentrated index is typically associated with greater volatility in the near term. Again, they're going back to that volatility talking point, okay? Instead of being relatively smooth, we're going to see huge gains, huge dips. Like my portfolio is surging by tens of thousands of dollars just over the last few months. I'm up 30 grand, I'm down 30 grand. I'm up 20 grand, I'm down 20 grand. It's been a roller coaster ride. I'm sure a lot of you watching this video have seen the same. So let's take a look at Exhibit 11. This is higher starting market concentration associated with higher volatility. You can see we're in the 10th decile, Okay, so in this chart, on the y-axis, you have 1 year of forward realized volatility. On the x-axis, you have market concentration. Right now, we are in the 10th decile. We are basically at all-time highs. This is the S&P 500 1 year of forward realized volatility based on starting level of market concentration, all the way from 1930 to 2024. Now, before we get into these superstar firms and talking about absolute valuations, I did want to give a shout out to today's sponsor, Policy Genius. The holidays are around the corner, and I have peace of mind knowing that the people that I love most are covered with life insurance that I found using Policy Genius. Many of my friends are having kids, they're starting families, so they're coming to me for insurance and investing advice. I always recommend Policy Genius because not only did I use it to find my term life insurance policy, but because the process was so simple and it saved me and my wife a ton of time. We spoke to one of their licensed experts. She gave us options based on the amount of insurance coverage and term of the policy that we thought was appropriate, and we went from there step by step. The process couldn't have been any simpler. With Policy Genius, you can find life insurance policies that start at just $292 per year for $1 million of coverage. Some options are 100% online and let you avoid unnecessary medical exams. My wife and I didn't have to have any medical exams, and we did everything over the phone. I like working with Policy Genius, and I recommend them to everyone that I know because they are simply a marketplace that helps people find and buy insurance. They're not an insurance company. So they can help you compare options by getting quotes from America's top insurers, and you don't have to worry about them having your best interest in hand. They work for you, not the insurance companies. Sometimes there are financial advisors or insurance salespeople that sell you the policy that makes them the most money while not having your best interest in hand, which I didn't have this worry with Policy Genius. So check life insurance off your to-do list in no time with Policy Genius. Head to policygenius.com/whiteboardfinance or click the link in the description to compare free life insurance quotes from top companies and see how much you could save. That's policygenius.com/whiteboardfinance. Okay, so the rise of superstar firms, which we're seeing today, if you look at NVIDIA, they definitely qualify as that. With economies of scale, such as today's mega cap tech stocks, is one reason why the S&P 500 trades at an elevated PE multiple. Okay, we talked about this earlier. So the 10 largest constituents in the S&P 500 account for 36% of overall index and trade at a forward PE of 31%, substantially above the 19x multiple of the remaining 490 stocks. Okay. The premium valuation for the top 10 stocks is the largest since the peak of the dot-com boom in 2000. Let's take a look at Exhibit 13. If you're still with me, if you're still watching, you're a double OG, triple OG potentially. Shout out to all the million. Oh, we're almost at 1 million subscribers. Can I get some love? The algorithm hates me. I don't post frequently. Okay, I don't make 17 videos a week. Just show me some love. Share the video. Okay, thank you. So absolute valuations from top 10 and remaining S&P 500 stocks over time. Again, if you look at the light blue, these are the 10 largest stocks. If you look at the dark blue, that's the remaining 490, okay? So again, it looks a little frothy at 31x because if you look at these, they used to be around 10 to 15x, okay, from 85 to 95. And then dot-com bubble, and then everything after 07, 08, after tons of money printing, stimulus, blah, 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 blah. We're sitting at a 19x for 490, and then 31x for the 10 largest, okay? So, nevertheless, it is a subject of debate among portfolio managers whether the market dominance of leading firms will persist over the next decade. Interesting. Let's take a look at Exhibit 15. This is maintaining rapid sales growth for 10 consecutive years. You can see 10% sales growth is light blue, 20% sales growth is dark blue. Obviously, these are trending down as you go down the x-axis to 10 years, okay? Only 11% and 3% maintain 10 plus and 20 plus over 10 years. So if we continue, their baseline scenario, if we start talking, if we get into their second metric of economics, their baseline scenario assumes that the U.S. GDP contracts in 4 quarters 10% of the time during the next 10 years. So their assumption is slightly greater than the past decade's experience of 2 quarters, 5% of the time, and slightly less than 5 quarters, 13% of the time, over a rolling 10-year historical average since 1950. So they're basically saying, hey, the U.S. GDP is going to contract in 4 quarters, 10% of the time over the next 10 years. 10 years times 4 quarters, rolling 40-quarter periods. See what I'm saying? 10 years, 4 quarters, 40 quarters. So what this means is percentage of observations on the y-axis, number of quarters with GDP contraction in a 10-year period. So their model is assuming 4 quarters. The average since 1950 is 5 quarters. And then from 73 to 82 was 11 quarters. 91 to 2000 was 1 quarter. Okay, so they're somewhere right in the middle, 4 to 5. It's a fair assumption, okay, or a fair piece of criteria. So the risks to their forecast is obviously, this is common sense, but I just need to say it to be fair to them. If economic growth during the next decade is stronger than their baseline expectation, the prospective equity return, the return on stocks, could exceed the high end of our forecast scenario. Yeah, no shit. Okay, so let's continue. So in July 2012, we published our original report detailing our view of prospective 10-year annualized total returns. They've done this before. Let's take a look at it in the chart. So if you look at this chart, let me zoom out just a little bit so you can see the whole thing. They have the total return on a log scale on the y-axis. They have the years on the x-axis. They did this in 2012 to 2022. They predicted 8% as their base case, and I believe it was, 12% as their high end. So where this light blue line is, where my cursor is 12, middle is 8, bottom is 4, and you can see that all of their forecasts got absolutely crushed. And then if you look at their 2020 to 2030 forecast, they didn't disclose what their percentages were, but if we go off this one, it's 6 in the middle, this dotted line right here where it's gray, and then who knows where we'll be. And then if you look at the 2024 one starting right here, the one that we're actually talking about right now, is that they have 1% low, negative 1% as the low, 3% as the baseline, 7% as the high. So you can see here the average was 8, 6, and now 3. So they've cut it 2% and 3% over their last 2 forecasts. What do you think about this? This is probably the most important chart that I'll show you today because they're actually showing you, hey, we were right, we were wrong. These are the actual results. Okay, so let's continue. Now, investment implications. This is the whole reason why you're watching this video. What should I put my money in? Okay, should I keep them in the S&P 500? Should I put that in Bitcoin? Should I put in real estate? What am I doing here? So they're taking more traditional assets such as the 10-year Treasury. So they're saying the current level of the 10-year U.S. Treasury yield and the current level of the 10-year break-even inflation rate. They're estimating the probability that equities, aka stocks, underperform bonds and inflation during the next decade. Interesting. Okay, let's see what they have here. Let's put some numbers to this. The distribution around our 10-year annualized total return forecast implies a 72% probability that the S&P 500 underperforms bonds, a 33% likelihood that equities generate a return less than inflation. So you're telling me there's a 33, 1/3% chance, okay, 3 out of 10, or 33 out of 100, chance that my stocks are going to underperform inflation? Do I need to buy I bonds? What am I doing here, Goldman Sachs? So a 4% probability that stocks post a negative absolute return. Why am I even investing in this? Getting crushed by inflation and losing money and losing principal. What's going on here? What do we do? Okay, so if you just look at this chart, they're basically just illustrating what they just talked about. 2 standard deviations down, that's that negative 1%. The baseline is 3%. 2 standard deviations up is 7%, okay? Bonds outperform stocks 72%. Probability the S&P 500 underperforms bonds 72%, underperforms inflation 33%, and then actually is negative over the next 10 years. There's a 4% chance is what they're saying, okay? So let's scroll. The prospect, I'm just trying to make this as big as possible for you. Sorry for all the zooming. The prospect that equities outperform inflation is more favorable than the likelihood of outperforming bonds. We estimate that the probability equities underperform inflation in the next 10 years is 30%, more than double the historical frequency of underperformance of 13%. It's almost 3 times. So relative performance of equities and inflation, you can see it's basically cyclical. Right here, they have equities underperforming inflation 13% of the time. So basically, since let's call it the mid-1970s to the early 1980s, and then after 07, 08, okay? So 13% of the time. Moral of the story is buy stocks, but maybe not this time. Maybe not 33% this time. Okay, let's continue. You got to have fun with this. These reports are boring, but you need to read them, okay? Everyone else glossing over and, doing the ADHD editing, where they're showing you 17 headlines in a second, and you're basically just sitting there like Neo in the chair in the Matrix, like, getting all this information uploaded to your brain. Let's actually see what the people on Wall Street had to say. Taken together, these relative returns forecasts suggest investors should be prepared for equity returns during the next decade that are towards the lower end of their typical performance distribution. So what they're saying is expect to have lower returns over the next 10 years in stocks. Okay, now, a lot of highlighting here, but I have to go through it. This is going to be such a long video. Whatever. History and the current high level of the market concentration suggests that the equal weight S&P 500 will outperform the aggregate index over the next decade. So instead of going through all this, basically what they're saying is, hey, really highly concentrated market cap weight, your NVIDIAs, your Apples, your Googles, your whatever, they're the ones that are taking the lion's share of the, let's call it VOO or SPY. The index itself is SPX, but I'm just saying the ticker symbols for people that they probably are more recognizable for them. So say you have SPY, say you have VOO, say you have some sort of S&P 500 index fund. If you don't know, those are cap weighted, right? So the point of the equal weight S&P 500 is to get some of the smaller caps in there. But there's better ways to do that. Just buy like a small cap value ETF. I buy AVUV, for example. There's other ways to get around this. So since 1970, the equal weight benchmark has outperformed the aggregate S&P 500 index during 78% of rolling 10-year periods by an annualized average of 2 percentage points, which is actually huge when you look at it on an annualized average, not total average, annualized, because that compounds. More recently, however, 10 years, 2014 to 2024, aka funny money years, okay, trailing returns for the aggregate index have outpaced returns for the equal weight index by an annualized 3 percentage points. Okay, that's a lot. So if you look at this, equal weight S&P 500 has typically outperformed the aggregate index. Equal weight underperformed the aggregate 22% of the time. Okay, so that means 78% of the time it's outperforming. If you want to look at any of these charts, just pause the video. I'm not going to take too much time because we still have like 10 pages to go. So by construction, the equal weight index tilt towards smaller stocks means its performance relative to the aggregate index is driven by the performance of smaller versus larger cap stocks. Long-term outperformance of small stocks versus large stocks is inversely related to the starting level of market concentration. That's their whole shtick behind this report, starting level of market concentration. The report is starting in 2024 when everything is highly concentrated. So they're thinking, hey, I need to discount for this net present value, not literally net present value, but my risk needs to be accounted for because I'm starting high, right? Buying high, selling low kind of a thing. Concentration is high. That means the future should be lower. That's what they're saying. So when market concentration is high, small stocks tend to outperform larger stocks by a greater magnitude relative to a more normal market concentration environment. So if you look at this, again, we are in the 10th decile, okay? We're pretty high. The relationship between market concentration and forward performance of the size factor means today's level of market concentration may be used to gauge the potential magnitude of equal weight versus aggregate outperformance over the next decade. Today's extreme level of market concentration, which we're in the 99th percentile, okay, suggests that the magnitude of equal weight outperformance over the next decade should also be stronger than average. So let's take a look at a chart. So right now, this is crazy when you look at this. The current high level of market concentration suggests the equal weight S&P 500 will outperform the aggregate index by an annualized 8 percentage points during the next decade. So if you look at equal weight aggregate, starting market concentration is on the left axis. You're currently at a 709x. Okay, that's crazy to me. And if you look at the equal weight, we're down here. Okay, so pause this, look at the 50-year average, take a look at this chart. This is a huge divergence and something you should consider, something I may consider for my own portfolio. I'm heavily invested in VTI. That's a bulk of my portfolio. But I may look into equal weighted S&P 500 funds after posting this. So our 3% annualized 10-year return forecast for the S&P 500 is below the consensus average of 6%. This is where we take a look at what other buy-side and sell-side companies are saying. So this is the assumptions of 21 asset managers, okay, publicly available data. The distribution of consensus annualized 10-year return assumptions range from 4.4% to a high of 7.4%. So if you look at all these other light blue lines, these are the 21 other managers that they found publicly available information on. The average is right around 6%. What's the market going to do? You have some people at 7.4, you have some people at 4.4, and look at Goldman Sachs. They are by far the most bearish at 3%, okay? And what they say is even the highest forecast from the distribution of estimates is roughly 4 percentage points below the long-term average annualized return of 11%, okay? So what they're saying is, hey, even though we're at -1 to 7%, in the middle is 3, and everyone else is at 4.4 to 7.4%, that's still 4 percentage points lower than 11 to 12%, which has been the annualized return over the past decade, which has been roughly 11 to 13%. So what they're saying is even though they're higher than us, they're still 4% lower than what's normal. So if we look at the Goldman Sachs consensus forecast, the index will deliver a below average annualized return during the next decade. Their baseline is 3%. Consensus average is 6%. If you look at the average since 1930, it's been 11%. Past decade has been 13%. This is crazy, okay? Since 1930, 11%. Since 2014, it's been 13%. They're predicting 3%. Now, if we keep going, yada, 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 what are other people doing? Hey, let's take a look at corporate pension funds. They're 23% other, 24% stocks, 54% fixed income. Okay, those are your bonds and things like that. Now, if you look at public pension funds, okay, 47% are stocks, 23% are alternative investments. Buy Bitcoin. 21% are fixed income, 7% is real estate, 3% is cash or cash equivalents. Now, if we keep going, yada, yada, yada. This is a pretty interesting chart. Let me zoom in. This is the historical distribution of S&P 500 CAPE multiples. Remember, cyclically adjusted price to earnings ratios. 90-year average is 22x. One standard deviation down is your Warren Buffett years of 14x. One standard deviation up is 30x. Cyclically adjusted, we are currently at 38x. Okay? Hot, hot, hot. I have no idea why I just said that. Higher than normal. Okay? If I keep going, I don't even know if I have anything highlighted the rest of the presentation. Yes, I do. This is basically just saying how many people are investing now. So note that the current household asset allocation to equities equals 48%, the highest share since the Federal Reserve began monitoring this in 1952. So more people are buying stocks. That's basically what this says. So if you look at light blue, that's household debt. If you look at light gray, that's cash. If you look at dark blue, household aggregate financial asset allocation, 48%. The blue line is equities, stocks. Last time this was the case, dot-com bubble. Ding, 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 ding. Any lights going off? Any light bulbs going off? Dot-com bubble crash. People said, don't want to be invested in this. Yes, I will. Yes, I will. Yes, I will. 0708 crash. Don't want to be invested in this. Yes, I will. Yes, I will. Yes, I will. Yes, I will. 2020 crash. Buy more. Stimulus. Money printing. Crash. 48%. Here is basically 50% of American households hold stocks. That's what this is saying. So that's what I think my last highlighted thing was. Yes, it is. Let's get into my thoughts. Is the market concentrated? Absolutely. Why is that? 401ks, index funds, mutual funds, everyone just goes at work and just presses Dave Ramsey, large cap, extra growth, high growth, do this, triple XL, double XL, Big Mac, let's do supersize me. That's what everyone does, okay? This whole country, this whole thing runs on 401ks, tax advantage, pension plans, all that stuff, right? So right now, what I'm trying to say is, yes, high concentration. Everyone has the Robinhood app on their phone. If you're watching this video, I promise you have some sort of investing app on your phone. Otherwise, you probably wouldn't even be interested in this. Half the country's invested, yada, yada, yada. Everyone buys index funds. The majority of my net worth is in index funds. Yes, a lot of money going towards the Magnificent Seven, a lot of concentration risk. I understand exactly what this report is saying. However, what this report doesn't talk about, my friends, has been my thesis for the last 10 freaking years. U.S. dollar dominance. Repeat after me. U.S. dollar dominance. Army, Navy, petrodollar, Air Force, the whole world uses the dollar. Okay, Lebanon, hyperinflation, use the dollar. Turkey, 35% inflation, use the dollar. Argentina, use the dollar. Pesos, what's that? Buy Bitcoin, right? So it sounds like I'm just rambling, but basically any country that needs money borrows in dollars and they use dollars, okay? Countries literally peg their currency sometimes to the dollar. If you look at some of these smaller Caribbean countries, for example. So what I'm trying to say in a nutshell is U.S. dollar dominance is still here. We still have the deepest, largest capital markets in the world. And Goldman Sachs probably wants you to buy something exotic from them, one of their exotic products that is probably going to underperform the S&P 500, especially when you take fees into account. So are they wrong on some of this stuff? Absolutely not. Are they right on a lot of it? Yes, they are. But at the end of the day, until the BRICS or, China, Russia, India, South Africa, whoever, Brazil, until they can actually trust each other and come up with a commodities-based currency, the dollar is still the strongest currency in the world and it's still used the most, right? So my analogy is if you're a manufacturing firm in Colombia and you can borrow in pesos at 9% or borrow in dollars at 6.5%, what are you going to borrow in? Obviously dollars, okay? You're getting a 2.5% spread in that hypothetical example. So what I'm trying to say in a nutshell is U.S. dollar dominance. Until that stops, I'm still putting my money where my mouth is, and that's mostly in VTI. Thank you so much. This video is probably going to be super long. You probably didn't even stay till this point. So I'm going to say something at the end of this video, and I want you to leave a comment. Just let me know. Okay, let's see. What's the word going to be? Something easy to spell. I was going to say like skedaddle or something stupid. Let's see. Let's say microphone. Let's just say microphone. If you even stayed till this long in the video, comment down below microphone, and I know who the real viewers are. Thank you so much for sitting through this. Let me know your opinions on this whole report, and also comment the word microphone in the bottom. Thank you so much. Bye-bye. Oh, yeah, this is Hank Paulson at Goldman Sachs. What's going on, Barack? Oh, Lehman Brothers failed. Everyone else failed. No one went to jail. I think I should get a bonus, and you know what? Let's keep Goldman afloat a little bit. I'm in your cabinet, but I just happen to be the CEO of Goldman Sachs before I started sitting in your... Oh, this is recording. Sorry. Delete.